welcome to everyone that has joined us online today for our 2022 Investment Insights presentation. I'm going to do a recap of last year and then speak to how we positioned going forward and how we see the year ahead. I'm going to be joined by Busi, Andrea and Michael, who will give further insight into their particular asset class building block solutions. So I'm sure all of you feel that sometimes it's difficult to be patient, both in our personal lives as well as with investing. Sometimes we just want to hurry things along. But 2021 showed that having a long-term horizon has very good rewards for investors. So as an investment team, our process is to achieve those real return targets for clients over the long term. Growth assets are an important driver of those long-term returns, and was very difficult when for a period of time you had cash outperforming South African equity, which is a key building block and asset class in our funds. At the time, there were naysayers that said South African assets could never deliver in an environment with low growth. But we stuck to our process and our philosophy, and that has seen strong rewards for clients and investors over the course of the last year in particular. There's been a big move towards passive investments, with lower costs clearly being beneficial for clients. But we have maintained a view that active can add value after costs if done well. And that has been a key driver of returns in the strategies over the last year, as our active managers have delivered well beyond their benchmarks. But it comes down to the four basic P's of having a philosophy and an approach in terms of how you're going to add value, a disciplined investment process, experienced people making decisions in the funds, and then having that patient long-term horizon. So growth assets were the clear winners in 2021, led by the property sector. In South Africa, local property did very well, as the leverage concerns that were weighing on the sector dissipated through the course of last year on the back of stronger growth, and as companies brought down their levels of leverage. Globally, property is a more diverse sector, and we've actually seen some of the underlying sector ending last year with better prospects than where they started before the pandemic. Equity is a key driver of growth in the funds, and we had very strong returns from both global and local equity. Global equity was driven to some extent by weakness in the rand towards the end of last year, but local equity has done very strong, with over 25% in local currency terms. Given the weakness we saw in the rand, you've actually had a decent return from global cash. SA bonds have done well again, and the laggards have been SA cash and global bonds. If we look at these returns over medium and longer term, SA equity has had a much better 3 years, now outperforming bonds, where for a long time it had lagged the bond return. Over 10 years, we've still got the global asset classes that are leading returns, but SA equity still providing a decent outcome over that period. So what has driven the very strong returns that we've seen over the last year? Well, if you look at the left-hand side of the chart, you have earnings growth for the world and US economy, and on the right-hand side, South African earnings growth. You can see the massive slump in earnings during 2020, but the even bigger rebound that we saw in 2021. So at the beginning of last year, there was a prediction and a forecast that earnings would improve, but the extent of it exceeded everyone's expectations. So that has been the real driver of returns in the last year. So how have we been positioned through this period? We have had a slight overweight to equity, which has benefited the funds. We have maintained an overweight to global equity over South African equity, but during the course of last year, upweighted South African equity quite substantially, with that underweight now being a lot smaller. Within fixed income, we have continued to favor South African bonds that offer much higher yields than what you are receiving offshore. We've also had exposure to longer dated bonds, which are offering much better returns and higher yields than what you've had at the shorter end or in cash. We've held no global bonds, but we have had a small exposure to global cash, mainly as a diversifier in the funds. In property, we've maintained the underweight to South African property, preferring exposure to South African bonds, but we upweighted our exposure to global property towards the end of the first quarter of last year, as we saw the fundamentals improving for that sector, with valuations still being compelling. Through the course of the year, we've mostly held a full weight to offshore. We haven't made any changes to our manager lineup over the last year, but we've had very strong performance from most of the building blocks, which I'll speak to in more detail, and that has really been an extra boost over and above what we've seen from markets in terms of generating good returns for investors. So looking at the building block returns over the last year, these returns are all net of fees. The building block returns are in green and the benchmarks in black. And it's very pleasing to see the strong performance from our building block solutions in the SA equity space, as well as fixed income. Over the last year, our managers within the local equity building block have outperformed the benchmark by about 7%. Fixed income has also done well, as we've had an exposure to the longer end of the curve, as I mentioned earlier. Within property, our local managers delivered returns more or less in line with the benchmark, while globally the managers have outperformed. I've included the South African Enhanced Income portfolio, as we use this in some of our lower return strategies, and that has also generated a return in excess of its benchmark, the STEFI. The only laggard over the last year has been the global equity building block. This has mainly been on the back of poor emerging market performance in the latter half of last year. Andrea will speak to this in more detail. If we look at the solution and the returns over the last 3 years, the South African equity building block is now 3% ahead of the capped SWIX on an annualized basis. We've had strong performance from our fixed income mandates, now also ahead of benchmark. The property building blocks ahead of benchmark, and again, the only building block that is lagged is the global equity, and that is mainly as a result of performance over the last year. But given our positioning within this building block, we expect to see a recovery in returns going into this year. So it's important to look at what the value add has actually been in numbers from using active managers and from tactically tilting asset allocation within the funds. So we have the 3 SIS funds with the annualized 3-year return that is signified by the height of each of the bars. And the orange or mustard color in the chart signifies the part of the return that is being driven by the strategic asset allocation. So we spend a lot of time modeling what is the best benchmark in achieving the real return targets over time. And over this period and over the longer terms, that strategic modeling has had big benefits for clients. Over and above that, our tactical asset allocation positioning has also added significant value, which is shown by the blue block in that chart. And then lastly, the value add from manager selection, shown in red, has also added significantly to returns over this period. This is for the last 3 years. If we look at it over the long term, that value add has varied over time, but over the very long term has added more than 1% per annum after all costs. And if one thinks of the compounding, that has been a big value add to clients over the history of the strategies. So moving on to performance, we've added one fund to our fund range, the Old Mutual Multi-Managers Worldwide Multi-Asset Funder Funds, with the same mandate as the SIS 3 to 5 fund. It is a balanced fund, but is not restricted by Regulation 28 and can hence have more in offshore assets. We firstly look at performance of the lower targeted return funds, and here, while the funds have slightly different targets, I've looked at them all versus inflation +3, and these funds are now outperforming the benchmarks and that target over all periods. With the strong returns we've seen from markets and from our underlying managers, we've had really good and strong returns over the 1 year across our balanced range of funds. That has seen the longer term returns move much closer to their targets. Now over 3 years, we're well ahead of inflation +5, and over the 5-year period where the strategies had struggled to get to that target, we're now at inflation +5. And on a 10-year basis, the fund's still hitting those real return targets. And then lastly, for our unconstrained funds, which aim to maximize returns over the long term, we've had a very strong outcome, not just over the last year, but over a number of years as equity markets have delivered, mainly globally. And then last year, we've seen very strong returns from the South African market. But these are all point-in-time returns. What is more important for us is that we have a consistent delivery on a rolling basis, given the minimum investment period for these funds. So looking at the SIS 1 to 3 fund over a rolling 3-year period against its target of inflation +1 to 3, one can see that the fund has had a very high hit rate versus that target on a rolling 3-year basis, with very strong returns over the last number of years. Looking at the balanced funds, and here we have the SIS 3 to 5 prudent fund against its target of inflation +3 to 5. Again, a high hit rate over rolling 5-year periods and a strong recovery over the last few years. For our more aggressive balanced funds, which target inflation +4 to 6, we've seen a steady improvement towards those targets. But given the weak performance we've seen in SA equity markets over the last 7 years, not yet there over a 7-year period. And then lastly, looking at the maximum return funds, as I said, trying to maximize returns, but here measured against inflation bands of 6 and 8%. It's very pleasing to see the strong delivery of that inflation plus target over a number of years. While the delivery of the real return is at the center and the core of what we do, we are very cognizant of the fact that the outcomes we deliver for clients also need to be competitive. We have listed our funds in the left-hand column, and then the CISA categories that we are comparing them to in the second column. Then color-coded the outcome for each of the funds over the various periods highlighted at the top of the charts. And it's very pleasing to see that over most periods, our strategy funds are now in the top quartile, with only a few in the second quartile. So all of our funds delivering performance in at least the top half of their respective peer categories. I've highlighted the SIS inflation +3 to 5 fund in grey. It is not technically part of the SA multi-asset high equity category, given that it is not bound by Regulation 28, but it is managed as a balanced fund and therefore comparable to the other funds. That fund has lagged the other balanced funds over the last year by a small margin. That's due to the fact that we've had a higher exposure to global equity. And while global equity has done very well in RAND terms, our SA equity building block, given the strong performance from our managers, has done better. So that has resulted in that slight underperformance over a very short period of time. So I've spoken a lot to what happened in the markets last year, but I'm sure what is top of mind for you today is what we can expect in the year going forward. And this got me to thinking about the stories we tell ourselves and the predictions that we make through time, and particularly at the beginning of each year. So I've just thought about what some of those stories are. We said that we need people in orange jumpsuits. We need to see accountability for corruption before things in South Africa can really improve. There have been questions around whether South African assets can deliver good returns in the context of poor and mediocre growth. And then I'm sure there's some people that have thought, well, why didn't we see that COVID was going to be different to some of the viruses that had come before? Why did we not recognize that in the beginning of 2020? And then something that we probably didn't even think about was the fact that inflation could become a problem globally again, having seen very low inflation for a number of years and even the threat of deflation. And while all of these things might have been very valid, it's interesting to think about what has actually panned out. We haven't seen the orange jumpsuits and the kind of accountability for corruption that we would have liked, but we have seen a positive trajectory of change in South Africa, where we've seen improvements in the likes of SARS, and even if I can say that, Eskom. And South African assets have delivered really good returns without the long-term growth trajectory really improving by much. And then around the question of COVID, if one had recognized the risks, would you then have reinvested into a market where those risks remained? And would you actually have had the benefit of foresight? So even if you know what's going to happen and you can predict what's going to happen, it's not always clear that things will pan out according to expectations, and then there are always things that one can't foresee. So the question is, what can we anchor ourselves to? And it comes down to the basics. Ultimately, it is about achieving a real return, because that is about protecting capital and generating wealth for our investors. And how does one do that? It's by having a valuation focus, by buying assets that offer that value to generate returns over the long term. And then it's about having a long-term focus. And what does that mean? It's about believing that asset classes that offer value will deliver those returns with a long enough investment horizon. If one just considers the last year, nobody predicted the strength of returns that we would see. And that again comes back to having that long-term focus, that you don't miss out when the opportunity for returns are there. And then, very importantly, we don't have a crystal ball. There are a lot of risks in the market today, and therefore it's important to build diversified portfolios that can be robust through time. But it is a balancing act, and it isn't easy, because sometimes cheaper assets come with more risk, and we've seen that in the South African context. And sometimes more expensive assets provide some kind of diversification, and we can see that in cash today. So ultimately for us, it's about balancing these different factors and trying to position the funds to achieve the goals in a sustainable way. So if you think about the balancing act that I spoke about, what are the things that we are grappling with today? Well, the IMF has just come out with an updated growth forecast for 2022, and while that has been slightly downgraded, it is still a robust 4.4%. At the same time, we've got very high inflation globally. While it is much higher in the US, we've seen inflation rise across the globe and in South Africa as well, and mainly on the back of energy prices. So the Federal Reserve in the US has come out saying that they're going to raise rates and taper back on the liquidity that they've provided to markets in an attempt to bring inflation back into their target band. But it's going to be a balancing act for them as well, in trying to curb inflation while not choking off growth. And that tension has already seen a lot of volatility in markets this year. In South Africa, the challenge remains the same, and it's one of growth. So while we've seen a very strong recovery from the pandemic, with very strong growth last year, that will see GDP recover to pre-pandemic levels probably by the middle of this year, the long-term trajectory for growth hasn't changed much. We've also had a very uneven recovery, where unemployment has increased materially over the last 2 years, while at the same time consumers are actually in a much better place as incomes have recovered. We've also had the support of very strong commodity prices. That was a massive boost to not just mining companies and their revenues last year, but also to the fiscus. And while commodity prices have come back slightly from the highs we saw in 2021, they remain at high levels and continue to be an underpin to growth in South Africa. But these are risks. What is really important is looking at what is on offer in markets today. This chart is a snapshot of valuation across the asset classes that we invest in. The yellow dots show the real returns that we expect each of the asset classes to deliver over the long term, and this is based on the longest history that we have for each of those underlying asset classes. The bars give us an indication of the value that is on offer in the asset classes today. So where the bar is above the dot, the asset class is offering more value and better prospects versus its history. Where the bar is below that yellow dot, asset class is looking a bit more expensive. If we look at the South African asset classes in blue on the left-hand side, it is clear that they still offer a lot of value today, and that is despite the strong returns that we have seen over the last year. On the right-hand side in red, we have the global asset classes. Global fixed income still looks expensive. On the right-hand side, though, we have seen some value emerge in the emerging market part of global equity. And while global equity still looks a little bit expensive on this chart, there have been pockets of value that have opened up over the last year, which we'll speak to in more detail. So I'm going to go into some of the asset classes in more detail before I bring some of the team members on to also give detail on the asset classes that they look at. But just looking at SA bonds, I've got the 10-year bond yield, which is the thick blue line on the chart. And one can see that after the recovery after the pandemic in April to May last year, that our bonds have been relatively stable over the rest of that 2-year period. So with the South African bond, we've also got some of our emerging market peers. And if you cast your eye to the middle of the chart to the end of 2020, you can see the big gap between our yield and that of our peers, with Brazil at that point at about 7% and Mexico even lower. And if you fast forward to the end of last year, you can see the dramatic change in yields for our peer group, with Brazil now yielding way ahead of our bonds, Russia having caught up with us, and Mexico also having moved higher. So why have we had a more stable outcome? Well, our growth has been much better than anticipated. We've had good fiscal discipline from our government. And then lastly, inflation in South Africa, while it's kicked up more recently, has still been very stable over this period and more stable than many of our peers. But it's interesting to look at the ORBI returns over the last 5 years and how those returns have been generated. So the brown line graph shows the total return for the All Bond Index in each of the years from 2017 through to 2021, while the bars break up the return and what has been earned from the yield versus from capital. And one can see the blue bar has been volatile over time, with sometimes one getting a positive capital return and at other points, like in the last 2 years, where that has been negative. But where the return has overwhelmingly come from is the yield on our bonds. And we continue to therefore be very positive on the real returns that can continue to be generated by this asset class. Currently, returns are underpinned by the fiscal discipline that we have seen, and also by the low inflation that we expect to continue going forward. So while we've seen inflation kick up at a high level due to energy prices, core inflation remains anchored at low levels. So very good real returns still on offer from our bond market. So moving on to equity markets. In the chart, we have the forward PE ratio, price earnings ratio, for our market in black, emerging markets in blue, the rest of the world in red, and the US in grey. And one can see that despite the strong earnings growth we've seen over the last year, that our market has continued to derate. That is partly due to mining and resources companies already reflecting lower commodity prices, but overall the market is still at compelling valuation levels. We think stock picking is going to be key going forward, and it will be dependent on company outcomes probably more than sectors, and Michael will speak to that in more detail. Then moving on to the global markets. Emerging markets, as we know, had a very tough second half, mainly due to the returns coming out of China, and it's seen that index derate quite significantly over the last year. The rest of the world, which excludes the US, has also seen valuations come down despite strong earnings growth being generated. The only sticky market has been the US, where at the end of last year, valuations, while they had moved down slightly, had remained at high levels relative to the rest of the world. But to get a greater insight into the detail of these markets, I'm going to bring in the rest of the team. So I've got Michael, Bussy and Andrea here with me. Michael, I've spoken quite a bit about how well the South African equity market has done this past year. Do you want to just shed some colour on how those returns were delivered?
Yeah, sure. So, I mean, as you've mentioned, it was obviously a very good year for South African equities. To put that in some context, the chart up on the slides at the moment is showing the calendar year returns for the all-share index. And while the all-share index isn't our equity benchmark, it is the South African equity index that has the longest history. And looking at the returns for 2021, you can see the returns of total return of 29.2%. That is the best return that the all-share index has delivered in over a decade. You have to go back to 2009 to find a year that was last as good as the one that we experienced last year. So, good year of outperformance for South African equity, and what that has hopefully done is restored some confidence in investors that South African equities and your growth asset classes can deliver the returns that we require as the cornerstones of our investment strategies. And I think if you look at what the South African equity market did, as a whole, but look at across the sectors as well, it was a broad-based delivery of returns. So the resources index was up 32%, the financials index was up just under 30%, industrials were up 26%. So you'd be forgiven for looking at the sectors and thinking, well, if I just bought anything, it all went up, everything would be fine. It was a pretty easy year to be invested in South African equities. But what I'll show over the course of the next few slides is that wasn't necessarily the case. There was a lot of dispersion between the stocks, within various subsectors. And what I'll show through the slides now is just looking at various different subsectors of those and just looking at the price return of those. So not reinvesting dividends. So just what the prices did from the start of the year to the end of the year. And just for context as well, I've added a dotted black line across the charts as well that show what the cap Swix did, so what our equity benchmark. So we'll look here first at the Resource 10 index. And the Resource 10 index is effectively the 10 largest resource companies in our market. Resources is a very broad group, so there's a lot of different drivers that move the stocks around. And as you can see, top of the list being Sasol, which had a very good 2021 after what was a very poor 2020, rising on the back of a rising oil price. The diversified miners, the likes of Glencore and Anglo American, did very well. But then you look at the things like the gold and the platinum stocks, and it wasn't as clear cut. So good performers of the likes of Goldfields and Anglo Platinum, but you contrast that with the performance of Anglo Gold and Sibanye at the bottom, who are effectively playing in the same area. So quite differing outcomes within the same sector. The next sector looks at the financial side of things and just looks at the banks in our market. And while every bank in our market was positive last year, you can see there are some big differences between the relative winners and the relative losers. So standout performance from Investec, who have both their PLC and their limited shares listed in our market. But then even the difference between the South African focused ones, where you have Capitec quite far ahead of Standard Bank at the bottom. So again, quite differing and diverging performances. And lastly, we'll look just at the industrial sector. So this is the Industrial 25 index and its constituents. And again, the 25 largest industrial companies in our market. And industrials is quite a broad term when it comes to this particular definition. So just looking at a few of the different categories and subsectors within that that grouping, we'll start by looking at some of the industrial rand hedges. And you can see highlighted on the chart here quite differing performances and different return experiences from the likes of Richemont at the top, who had a very good year, as did most global luxury goods companies. But you contrast that with the performance of the likes of British American Tobacco, Anheuser-Busch, and right at the bottom, our index heavyweights, Naspers and Prosus, who had a pretty terrible year on the back of heightened Chinese regulatory risks that I'm sure Andrea is going to talk about a little bit later. Similarly, you look at the likes of the telecommunications companies, so MTN right at the top, one of the top performers in our market last year, and you contrast the fortunes of that to the likes of Vodacom and MultiChoice, which, you know, while not being a cellular network service provider, also gets classified as a telecommunications company. And lastly, looking at things like the food retailers, so the likes of ShopRite at the top with Woolworths, which is not exclusively a food retailer, but it is increasingly a large part of the company, and contrast that with the fortunes of Spar sitting at the bottom. So we saw quite a lot of divergence in our market, and even within sectors, it wasn't all one-way traffic. There were quite big winners and losers within the sectors, and so stock picking throughout the course of the year was quite important.
Thanks, Michael. So a lot of breadth in the market and a lot of opportunity for stock picking. In that context, how did our individual managers do? And I think importantly, what advisors will want to know today is what are the prospects for the South African equity market going forward?
Yeah, so quite a lot of divergence in our market and quite a lot of breadth, dispersion, the same, two sides of the same coin, basically the same thing. Market breadth effectively refers to the difference in the opportunity set. So in environments where breadth in the market is greater, which is what we saw in 2021, that is a time where if you've got a skilled asset manager, that they can add a lot of value in terms of the performance and the ability to outperform a benchmark. And if we look at just what our equity managers delivered over the course of 2021, you can see that has come through in our funds, where all 6 of the equity managers that we use within the South African equity building block outperformed the benchmark last year net of fees. The standout manager over the course of 2021 was M&G Investments, or the investment manager formerly known as Prudential. They did really well last year out of sticking to their process in 2020 and a disciplined process of in the downturn investing in those shares that showed relative value and relative opportunity, and a lot of those high conviction calls came through for them last year in the likes of big overweights that they had in MTN and Investec. The second best performer within our building block last year was the boutiques portfolio, made up of relatively smaller managers of 361, Battelier and Laurium. Those managers, being relatively smaller than the big players, have the ability to get down the cap scale, and they did quite well out of investing in some of those mid-cap SA Inc. opportunities there, where the value became extremely apparent and were subject to corporate actions. And even the likes of Coronation and in 91, who approached the market and approached building portfolios very differently, which is why they work so well in a blend, both doing very well in 2021 as well. So what we've seen in the context of the strategy returns, where a very good year has the impact of lifting some of the longer term outcomes, we see the same in terms of outperformance. So a very good year in terms of equity manager outperformance. And what that's done is it's lifted a lot of our medium term and longer term outcomes, where now the combination of our asset managers is ahead of the benchmark in the SA equity context, going out to around 15 years. In terms of the outlook, while we would love to see a repeat of 2021, I think the expectations of probably a bit more of a muted year, where we see things revert back towards their longer term averages. But in the context of South African equity and the stocks and the companies that are listed here, there are still quite a few things that are in favor of those companies. What we've seen throughout the crisis is that a lot of the companies listed here took the opportunity to right-size their balance sheets. They've managed their debt very well, and coming out of the pandemic have come out in quite a strong position, where they are fairly well positioned to deliver earnings growth. And what we've seen through company results is we've actually seen a lot of South African listed companies surpassing expectations and beating the consensus when they've reported results. So the companies are actually in a much better position and have been a lot more resilient than I think a lot of people thought. The other thing going in the South African equity market's favor, as you showed earlier, was that the valuations and all of that were still very attractively priced, even with the very good year that we've had in 2021. So that is attractive not just relative to its longer term history, where we are cheap in an absolute context, but also cheap in a relative context, where when you compare the valuations of the South African market to those offered overseas, and particularly in developed markets, our market still looks fairly attractive.
Thanks, Michael. It's encouraging when we look at something like business confidence that is also picked up in the last year, despite the challenges we face here. So we've seen companies doing a lot better, but business is also feeling more optimistic. Thank you. Andrea, global equity has been a very interesting place to be in the last year. It's a very diverse asset class. You've got lots of regions that fit into one index, and we've had very different performances across the board. Can you just shed more light on what exactly happened last year and what those divergences in returns have been?
Certainly. Thank you, Monene. I think one of the themes that I would like to highlight for 2021 has been the uneven recovery in performance across global equity markets. And the large discrepancy in performance and in returns among some of the larger regions and countries around the world. So for instance, on the one hand, you have the US market, which was up some 27% in US dollars. On the other hand of the spectrum, you have MSCI China, which lost close to 22% in US dollars. And pretty much in between these two extremes, you have the rest of the developed world, as well as the rest of the emerging market world, having offered a very decent performance in US dollars, some 13% and 10% respectively. One thing I would like to highlight about the US market is that the recent really great performance of last year was on top of very good 2 years prior to that. So in fact, the US market has delivered just over 26% on an annualized basis over the last 3 years, which is really an amazing achievement if you think about it, considering that we've experienced a global pandemic as well as economic shutdowns about halfway through that period. There were clearly a number of factors that worked in favor of the US market and supported performance throughout the course of last year, amongst them being the faster vaccine rollout programs throughout the country, but also the very strong corporate earnings delivery as well as increased consumer demand. On the corporate side specifically, US companies have been able to deliver record profits throughout the course of last year, predominantly driven by excess liquidity levels as well as pent-up consumer demand. Not only that, but many US companies have been able to cut costs quite aggressively throughout the original phase of the pandemic, which has enabled them to operate more efficiently throughout the recovery period post that, which obviously has contributed really meaningfully to the earnings base delivered during the course of last year. Now, as I mentioned, on the other side of the spectrum, China's underperformance was as a result of some negative developments that have taken place over the course of the year. So we've had tighter regulatory environment, which has affected negatively a number of industries, but more importantly, the broader internet sector which houses some of the giant tech names in China, such as, for instance, Alibaba and Tencent. So although tighter regulation is certainly nothing new for businesses that operate, particularly in China, this did happen against a backdrop of a cooling economy, which obviously put further downward pressure on prices. The property sector also faced immense pressure, particularly throughout the second half of the year, as the Chinese government sought to deal with the high levels of indebtedness of many of the Chinese property developers. Clearly this created concerns around the future growth prospects of China, given that property is quite a meaningful component of the Chinese economy and also a large employer of labor. Having said that, I think it's quite interesting to note that a lot of these trends, they're not expected to continue indefinitely. And for instance, what I've seen in terms of market performance so far this year has been a change in trends of what we've experienced throughout the course of 2021. So if you look at the first 3 weeks of January so far, we've experienced a broad-based sell-off in the US market, and that's been really on the back of concerns around high inflation and the persistence of that for longer than previously anticipated, but also about the impact of rising interest rates at a faster pace than previously expected. With that in mind, so we saw the US market losing just over 8% in US dollars versus more benign losses from the rest of the world in US dollars. And actually on the other side of the spectrum, we have China, which actually managed a small absolute return for that 3-week period in dollars.
Thanks, Andrea. And that comes back to what we spoke about earlier in terms of valuation. So the markets that have been cheaper have held up well. It's clearly only a 3-week period. But maybe that leads us into speaking about what are the underlying trends in terms of what happened through last year that impacted on the performance of our building block, specifically in the context of what you've spoken about.
Certainly. The first half of 2021, and more precisely the period between January and May, was all about the global growth recovery story. In that environment, we saw bond yields rise, we saw value stocks outperforming growth stocks, small companies outperforming larger companies, as indicated by the red bars in this graph. And at the same time, emerging markets began to marginally underperform their developed market counterparts. Now, within that context, our value-oriented managers actually did quite well. They were actually well ahead of the benchmark throughout that period. But our overweight exposure to emerging markets had detracted marginally from relative performance. Now, fast forward to the second half of 2021, a period when the headlines were all about inflation, they're all about pessimism around further COVID variants and the impact of that on future growth prospects. So certainly within that environment, we saw a complete change in trends, or reversal in the previous trends. So we saw bond yields coming off. We saw growth stocks outperforming value stocks, large companies outperforming smaller companies, as indicated by the bars mastered on the graph in front of you. At the same time, emerging markets continued to underperform their developed market counterparts to a much larger extent versus the experience during the first half of the year, but more importantly in China for the reasons that we discussed earlier. So that obviously put quite a lot of pressure on the relative performance of our global equity building block, again, given the overweight exposure to emerging markets. And again, that overweight exposure to emerging markets is not only expressed through our exposure to specialized emerging market managers, but also via our active global equity managers who also had or held relative, different levels of emerging market exposure, particularly in China. Now, although growth stocks did outperform value stocks during the second half of the year, our growth-oriented manager, Bailey Gifford, did not benefit from that trend as much as expected. On the one hand, given the manager's overweight exposure to emerging markets, and particularly China, but also as a result of the manager's preference away from large growth companies, which were the better performance during that time period. So in a nutshell, most of the underperformance of the global equity building block actually came through during the second half of the year for the reasons mentioned.
Thanks, Andrea. And now looking forward to this year, I think the key question is, where are valuations? I showed that, for some parts of the world, you have had, markets derating over the course of last year. But do you just want to give us more color on what valuations are looking like for the global market as a whole?
Certainly. So as you mentioned, one of the interesting things to note during the course of last year is that pretty much all global equity markets have derated. So this was primarily driven by very strong earnings growth numbers that have come through well above the price movements of those specific markets. And this graph actually illustrates it quite nicely. Each grey column represents the range in valuation for that specific region or country, with the middle line representing the median. The purple triangle represents the valuation of that specific market 12 months ago, while the green diamond represents the current valuation. So you immediately notice that all global equity markets have indeed derated throughout the course of last year. Having said that, and as you've shown on previous slides, Monene, as well, it's worth noting that the discount between the US, from a valuation perspective, between the US and the rest of the world has actually widened by around 10% during the course of last year. So what that means is, from a valuation perspective, the US continues to trade more and more expensively relative to the rest of the world. And for that reason, we continue to remain comfortable with the current underweight position to the US and an overweight exposure to other regions such as Europe, UK, as well as emerging markets, given that valuations on a relative basis are a lot more attractive. The other thing I would like to also point out is that unlike the South African market, global equity markets in general certainly don't look very cheap when compared to their respective long-term averages. However, we do think that current valuations are reasonable, given that corporate earnings growth expectations for this year as well as next are not demanding.
Thanks, Andrea. The other part of global, our global investment has been in global property. And I think if we look through the pandemic, or when the pandemic started and you had lockdowns and people working from home, it looked like the prospects for property were going to be pretty dire. But we've said before that global property is a diverse asset class. So Busi, can you just start and just show us what that actually means, what the sectors are, and what has really happened within this asset class over the last year?
Sure, Monene. I mean, like you say, global property had an exceptional year last year and really bouncing off the lows that were recorded in 2020. And this was largely on the back of the faster and stronger economic recovery that we saw last year than was anticipated. And if you look at the different asset classes that you have there, you can see that all of them posted double-digit returns for the year. But while, that's the case, you can also see that the return outcomes were quite varied. And this really talks to the diversification benefit that investors get from this asset class, which is global property, with no single underlying sector making up more than 20% of the benchmark. Now, to go into a bit more detail, just looking at the underlying sectors, you can see there that in red, that the industrial sector was by far the best performing sector in 2021 and actually recorded its 9th consecutive year of outperformance. Now, this was really on the back of very strong demand that continued. Like I said, 2020 was quite a strong year for industrials, but we saw that that demand continued coming through, and industrials really benefiting from the rise in e-commerce and obviously enabling that environment. And then secondly, you also saw sectors like infrastructure and data centers also doing quite well, and also benefiting from the demand that continues and to come through within those sectors. And specifically those centers house what we call the digital economy, or they house the tech that really enables the digital economy. For an example, with the better part of the population that had to work from home during COVID, we saw cloud computing becoming a thing during that period, and that, those sectors really enabling that. And then another one that was quite interesting is retail, and we know that retail is largely dependent on people movement. And actually, we saw a similar story locally, where we saw retail bounce quite strongly last year. And this was really on the back of pent-up demand, as we saw COVID restrictions getting eased. We saw a bit of recovery coming through, and also with the growing vaccination rates or vaccination levels that we see globally, that has certainly boded well for that sector. And then on the flip side, the laggards across those sectors continue to be hotels, as well as you can see, the office. And similarly to retail, they also depend on people movement. But I mean, with all the stops and starts that we've had during this period of COVID, it's become a challenge for the office sector, because while some people will start to return to work, and then another variant would come up, and that really has continued to put pressure just in terms of vacancies that within that sector, and as a result, obviously, the rentals that you are able to collect within there. And then also with hotels, hotel again, I mean, we have seen a bit of a bounce again on the back of a recovery from the leisure travel aspect of hotels, but that sector is also largely supported by business travel, and we know that hasn't really recovered to levels even close to what we saw before COVID. So while we have seen a bit of a recovery, there continues to be a lag in those two sectors specifically. But I think, I mean, just to sum it up, overall a very good return outcome from global property. You can see there that posting about 23% returns for 2021, and that's excluding income. On a total return basis, you actually saw about 26% return in dollar terms.
That's a fantastic outcome from an asset class that wasn't looking so great, a year and a half ago. But I think it's important to talk more specifically about the fundamentals for the sector going forward, particularly in the context of higher inflation globally. Property companies have set rentals, and how do you expect companies to do in this, or what do you expect the prospects for companies to be in an environment of higher inflation?
Yeah, certainly, Monene, and that's, a topic that's top of mind even within this sector. And like Andrea highlighted, we have seen a bit of a comeback, even year to date within global property, and that's really on the back of those concerns. People, the inflation scare. But if you just look at specifically within this sector, with the recovery that we've seen from an economic point of view, that has also brought in, a rebound in tenant demand. And if you just look at that on the chart there, where we plot occupancy rates, you can see that during 2020, occupancy rates actually fell quite markedly. But you can also see the bounce that we've had since. So you have seen the demand, recover quite strongly, although we're not really back at levels that we saw pre-COVID, which is 2019. But if you really look within the sectors, the underlying sectors, there are actually sectors there that are past pre-COVID levels and actually recorded record levels of occupancies. For an example, if you look at industrial sector, recorded about 97%, just in terms of occupancy rates. And if you look at self-storage as well, if you look at the long-term average for self-storage is roughly around 90%, and it actually reached levels above 95%. And that really talks to the demand that is coming through within these sectors. And obviously, it's quite different for other sectors, like I said, for an example, with office and hotels, which are kind of pulling down that overall occupancy rates there. But also to highlight the point, if you look at the rental growth expectations going into 2022, those remain quite solid. I mean, if you look at residential sector, just last year, we saw double-digit rental growths in most markets across the US. And again, that talks to the fundamentals that remain quite constructive within this asset class. And you can see across the other sectors as well, for most of the sectors, more than 4% expected rental growth for the year. And so, Monene, overall, we are very constructive on global property, while valuations may be, somewhat full. But if you just look at demand that exists from an earnings growth outlook, the valuations will remain quite supported. And also from a supply point of view, which is quite key. So supply is also quite constrained or at moderate levels. We have seen quite a bit of supply come through, for example, in industrials in response to the demand that is in there, which is a sector that we continue to monitor alongside our managers. So you have seen a bit of supply come through, but that is still at quite moderate levels. And then also lastly, I just want to highlight, unlike what we saw locally, where we had concerns around leverage, with the sector having been highly leveraged. If you look globally, balance sheets, they are still very strong, and that should continue to support, the sector in the event of the unforeseen coming through. If you look overall at leverage overall, it's sitting at levels well below its long-term average. Yeah.
Thanks, Busi. That's given us wonderful detail on the strong fundamentals that underpin the global property sector. And as we mentioned earlier, with inflation and the Federal Reserve raising rates, we will experience the kind of volatility that we have so far this year. But it's about having the patience and sitting through that volatility for the value that we expect to continue to come through from the global property sector. So thank you very much today for the insights and more detail on your individual sectors. And we'll just finally go to a conclusion. Thank you. Big thank you to the team for joining me here today. I'm sure you'll agree that the insights they gave us into the drivers of returns in their asset classes was very insightful. So bringing this all together, how are we positioned going into the new year? We've taken some profits in equity and trimmed our exposure back to neutral. We've spoken about the valuation opportunity that is still on offer within South African equity that we think our active managers can still benefit from. And then within global, there are pockets of value, and we are positioned to take advantage of that. We haven't made any big changes within the property sector. The only big change we've made is within our fixed income building block, where we've moved some of the exposure from the flexible fixed income fund to the enhanced income building block. Just to create some defensiveness in the portfolio after a very strong year. We've done this more so in the lower return strategies, where the target for the real returns is lower and where that enhanced income fund is still offering a good real return. So investing requires patience. We've already seen heightened volatility this year as the market grapples with some of the risks that we have spoken about. But there's still valuation on offer and the ability to generate real returns in what feels like a very uncertain environment. So our key message is that we're building portfolios that are diversified, that are taking advantage of the valuation opportunity that is on offer, and ultimately it's about staying invested. Thank you to everyone that has joined us today, and we look forward to hopefully seeing you in person in the coming year.